Welcome, everyone. Thanks so much for joining us. I see everyone starting to come into the room. My name is Missouri Colley, and I'm Development and Database Manager with Women's Foundation California. We're extremely honored to welcome you to this session, which is all about home buying basics. In this session, we're going to cover pros and cons of home ownership, obtaining a mortgage, inclusionary housing programs, shopping for and maintaining your home. Those are just some of the things that will be covered. We're going to be led in this discussion by Teresa Garza, who has over 20 years of experience in housing counseling, real estate finance, and financial coaching. So we're definitely in very capable hands. I'm very excited for her to share her expertise. I do also want to encourage all of you to share your introductions down in the chat, your name, your pronouns, any organization that you're representing, and also the native land that you are joining us from. So Nina shared that description also in the chat. So without any further ado, I'm actually going to turn it over to Teresa. And again, thank you so much, everyone. I look forward to absorbing all this new information. Thank you.
Hi, thank you. Welcome, everyone. Thank you so much for being here. I am going to share a PowerPoint presentation with you. Pardon me, but I just wanted to say hello and welcome first, and just add that I am a counselor. I'm also a marriage and family therapist and working on financial therapy. So it's all really related. My long career in housing showed me that there can be strain and stress from financing. Buying a home has been compared to some of the biggest, most stressful events in someone's life. Even though it can really be a positive, the process can be stressful. And all of that pushed me to look for more resources and more training, which is why I decided to also become a therapist. So I work in a wide range of fields. And I'm just really excited to share all this information about housing today. I do encourage folks to put questions in the chat as we go along. We'll have someone monitoring the chat for you so that they can let me know what the questions are, and that we will periodically check in with folks to see what needs to be clarified as we go along. And if anyone feels comfortable and would like to unmute and share, that is also welcome. Okay, I'm going to go ahead and share this presentation. Can everyone see the screen, or can someone see the screen? Can someone let me know if they're off mute?
Hey, Teresa, I'm not seeing your screen.
Not yet? Okay, give me one moment. Let me try again.
Okay, no.
How about now?
Yes.
Is it the presenter view, or can you see all my notes and stuff?
We need to go into presenter view. Yeah, we can see your notes.
All right, thank you.
Yeah.
View. Oh, I'm having some trouble. I apologize.
No worries.
There we go. How does that look, Dina?
Oh, no.
I apologize.
Oh, there we go.
That?
Yeah,
all right, thank you.
Yeah.
Sorry for not clicking there we go. All right, thank you so much for your patience. So the first, well, we already did this, so you know me, thank you. Now I would love to hear from folks. If you would like to put in the chat, or if you're feeling like you want to share, you're welcome to unmute yourself. What does home ownership mean to you? It could be different for each of us, but really what I'm trying to get at is what's your why? What will owning a home either change for you, or bring for you, or do for you? And if you can share in the chat, I'd love to hear from folks on what is their why. And I'm seeing some things: security, stability, customization, legacy, opening doors for the future, freedom, a home to call my own. So I'm seeing some great answers in here. Thank you. Building a family. Home ownership, more projects, more problems. Yeah, that's important to keep in mind too. Achieving the American dream, a dream come true. So I'm seeing the word dream. Building, security is coming up again. Thank you so much for sharing. So in coaching, we always want to get to our why if we can, right? It's not always possible. Sometimes it's a thing I need to do, and maybe it's not the number one thing on my heart, but it's important. Figuring that out, why is it important to me, can really help us find that motivation to stick with the plan, because homeownership is a very, like I mentioned, can be a stressful process, can be a long process, something that we have to stick with depending on which market you are. It can be a little bit shorter, it can be a little bit longer. So holding on to that why, especially as we're building towards those steps and the pieces that we need, the building blocks that we need to get to our home ownership. And so this brings me to the next thing that I wanted to ask is so you mentioned some of the reasons why. What are the things that you think would be advantages of owning a home? And what are some of the things you think might be disadvantages of owning a home? Because most everyone put a lot of really positive things, which I love to see. And one person said more problems. And that can be true as well. And so we want to look at it from both sides, or many sides if we can, to know what are the things that this could bring me, and what are the things that that could bring me that maybe aren't going to be the the most fun part of homeownership, but it's going to help us have a realistic picture of what it can be like. Okay, repairs and maintenance. Yes, right. When we rent, we can call a landlord or a property manager to come help us with repairs and maintenance. And that could be the work of repairs and maintenance, and also the financial aspect of repairs and maintenance. Taxes, right? When you own a home, you do have to pay property taxes. So we all most likely pay sales tax when we purchase things, and income tax on any income that we earn, but we don't all necessarily pay property taxes. But when you own a property, then you will be responsible for property taxes. Thank you. Advantage, building a legacy. Disadvantage, debt. That is true. The cost of homeownership usually requires, for most people, some amount of debt to take on to pay. Now, some people, yes, can buy cash, and if you can, I applaud you, but many of us will take on debt. Building equity, right? So what does that mean? Equity is the portion of your home that you own that is greater than the amount of debt, right? So if I bought a house for $200,000 and I owe $100,000, that difference between what I can sell it for and how much I owe, that's what we call our equity. And so yes, you can build that equity as you pay the loan down, the mortgage down, and as you live in there longer and longer, or maybe make improvements and it goes up in value, you're building equity. No more rent. Someone else said equity. Financial restrictions. Yeah, there could be some restrictions on the home that could be restrict your spending because you now pay a home. Restrictions based on the neighborhood or the tax district that say you can't build X on your property, you can't build Y, or the lender might say you can't do certain things, like buy it and then just give it to someone else if you still owe on it. So there will be different restrictions. Let's see. Advantages, paying the property to instead of paying a landlord. Disadvantages, again, maintenance, repairs, fixing things like water, heat, roof. More stability. Someone mentioned upfront cost on top of debt. Yeah, y'all really are knowledgeable here. It seems like you've pretty much covered what I was gonna share today. So here are some of the things. An advantage. I think people talked about taxes, of having to pay taxes, but we missed tax deduction. Some of us could get to reduce some of our taxes by the interest that we pay on the home, that we can write that off as a tax deduction. And so that could be a benefit. Building equity, we mentioned, stability, control, community. I heard most of these things from everyone. I don't know if I heard community, but I do like that idea of I'm putting down roots, I'm going to stay somewhere longer term, and I can start to work on building that community around me. Now, you can also have that as a renter. I don't want to act like it's exclusive. But if you know you're staying in a spot, it might encourage you to build that community. And then disadvantages, the big cost upfront, right? We all need a down payment to purchase. Ongoing costs, right? And the paying the mortgage every month, and maintenance and repairs, which can also be part of ongoing cost. Decreased mobility, right? If I want to leave my apartment, I give my landlord a 30-day notice, and then I can just move. With the house, it's not quite as simple. You could just get up and move, but you still have that debt. You still need that maintenance, maybe repairs. Maybe you rent the property. Maybe you need to sell it before you can move because you need the money to move or to buy something else. So it's not quite as easy to pick up and go. And then a big debt, which we mentioned. And so here are some of the costs of buying a home. When we talk about upfront cost, down payment. So we typically need to give a percentage of the purchase price. The lowest I've seen is about a 3% down payment. And then the highest can be up to what you can afford. This will depend on things like how much the home is worth, how much you can afford, what you want your payment to be, what the lender requires based on your credit score or the value of the home. So it can vary, but we do need to put money up front. It's pretty difficult to get in with no money down unless you're a veteran or a spouse of a veteran. VA loans do offer zero down payment for purchasing. You also need to pay closing costs. So I think a little further down the line, I'll talk a little bit more in detail, but closing costs are things that you spend in order to purchase the home. So when you take out a loan, you need to do things like get an appraiser to come out and look at the house and tell you what is it worth, a property inspection to make sure that it's in good condition. Those are things that are part of closing costs. So that's in addition to your down payment. So if someone says, oh, you just need 3% down, great. 3% of $100,000 house or a $200,000 house, that's $6,000. It sounds pretty manageable, reachable. But don't forget that we still need to add in closing costs. And that can be another 3 to 5% of the loan amount. Then you have to have escrows. So what are escrows? Those are usually part of the upfront cost, and that is the part of your payment that's not just the principal and the interest. So when you pay back debt, you pay back the principal with some interest. And with a house, though, they'll also ask you for a portion of the property taxes. So whatever it is for the year divided by 12. And a portion of the property insurance, whatever that is for the year, divided by 12. And so that's also included in your payment. And so you'll need to give a portion of that upfront as well. So when I move into the house, I have already paid the first year of insurance. And then every month that I make my payment, they're taking that amount and saving a part of it for the next year. And then same thing with property taxes, right? In California, they are paid twice a year in April and November. And so if I were to buy a house today in January, they would say, well, we need your taxes for January, February, and March, because come April, you just bought a house. You're not going to have enough maybe to pay us. So we're going to take it from you ahead of time. So that's all part of the escrows. Taxes and insurance, things that are another way to think of them are prepaid. And then reserves. So what are reserves? So once you pay your down payment and your closing cost and your escrows, which a good rule of thumb, I would write down, plan for at least 10% to cover all of these things. So if I buy a $100,000 house, 10% of that is 10,000. If I buy a $200,000 house, 10% of that is 20,000, and so on. If I buy a $300,000 house, 10% of that is 30,000. So we're planning for around that much upfront. And please, if you're feeling like, oh, that's too much, just know that there are ways, and I encourage folks to go to our money management classes so they can talk about ways to save. And then at the end of this presentation, I'm going to talk about some of the ways that you can also find down payment assistance. All right, so once you have all of those things, you pay all that out, they don't want you to move in and have $0 because you still need things like what's on here, moving cost, right? You're gonna need to get a moving van, or maybe friends can help, but you'll have to move everything. Cost of maybe filling your home, right? You want new curtains or new furniture. And so they ask you to have what's on here as called reserves. So they're going to say, once you pay all your down payment, closing costs, and escrows, we want to make sure that you have enough to make at least your first or second or third or up to 6 months worth of payments. And that again comes down to credit score and property value, et cetera. When they evaluate you as a whole, they're going to say, "Ooh, really good risk, no problem. You just show us that you have your first 3 months payments," or "We're a little bit worried this payment is a little bit high for you. We want you to have 6 months so that we know once you move in, you have some cash to go and you're not left with no money at all." And then we have ongoing cost, a mortgage payment. That's the part we pay every month. Utilities, important to think about. I encourage folks when they're shopping for a home to ask for utility bills so that you know what it costs to pay the utility bills in that home. It's going to depend on, weather, area, size, construction, how insulated it is, etc. And then maintenance and repairs. You can also ask for a list of what have they already done, what have things cost for them to repair, what needs to be repaired. You can ask the seller and you can ask the person who does your inspection. So these are some of the costs that are associated with purchasing a home. Now, what is a mortgage? We hear the word mortgage, and anyone's, if they want to take a crack at it, you're welcome to put it in the chat. What is a mortgage? People will tell me, "Oh, it's my debt." When I say I have to pay the mortgage, that means I have to pay that big debt I have on the house. Some folks will say, "Oh, it's my monthly payment." I call it the mortgage. I need to pay the mortgage, and I'm talking about my monthly payment. And all those are used interchangeably. But to get into specifics, it's a promissory note. So if I borrow $200,000, I'm going to sign a paper that says I owe the bank $200,000, right? Or if I put my 3% down, then I owe them $194,000. So I'm signing a note that says I promise to pay. And then the mortgage or the deed of trust document is a form where you're signing that says, if I don't pay this deed is not really mine. It's not free and clear until it's paid off. So if I don't pay, then they have the home as collateral. And that makes a mortgage a secured loan. It's secured by the home. So if you do not make your payments, it's backed up by that collateral, which is the home. So it is a secured loan. So those are just some basic terms about a mortgage. And here's what I was talking about just a bit ago when I said, when you pay the payment, it's not just the principal and interest. So the house payment includes 4 parts. We call them, you might hear a lender call them PITI, stands for principal, the part of the loan that you're paying down. Interest, the part that's the cost of them loaning you the money. Taxes, the property taxes that you will owe the county that you live in. And then insurance, the cost of insuring the home in case of a fire or another kind of harm to the home, a damage to the home. So you might hear folks say PITI, you might hear folks say your PITI payment. And in this insurance category at the end, the I, it also includes sometimes mortgage insurance. which I will get into detail about that, but it's another type of insurance that protects the lender in the case of you defaulting. So sometimes we see a commercial that says, oh, borrow 300,000 and your payment's only going to be $600. And that might be true, but that might only be the principal and interest. That's why it sounds so low. So if it sounds too good to be true, you want to ask, is it including the taxes and the insurance? Because I know as a homeowner, I have to pay that. Let's see. Thank you, Nina. And Nina's encouraging folks to please share any questions in the chat. So these are the 4 parts of the monthly payment. Sometimes they let you option out of them and say, no, I don't want to pay the taxes and insurance. I'll take care of that on my own. But typically that is only offered to folks who pay at least 20% down up front. So you give a big amount up front and then they say, okay, this person is showing that, they have a good amount invested in the home. So we'll trust them to pay their taxes and insurance on their own. But if you give less than that, they typically will put it into your payment because they want to collect it from you because they want to make sure that it gets paid. It can be a big, oh, thank you. I see a question here. I will get to it in a moment. They don't want you to not pay your taxes or not pay your insurance because that puts the lender at risk. If you don't pay the taxes, the county can say, hey, I'm taking this home. This is my home. They're owing me taxes. I'm going to foreclose and get my money out. And if it's not insured and there is a fire or there is some kind of damage, then it won't be covered to fix it, right? And their investment is only as good as what they can recover from the home. So it's a way to protect them. I think it can also help you as a homeowner. You're breaking down the payment monthly and not having a big bill once or twice a year. But it takes a little bit of control. And that might be a callback to one of the comments that someone put, which was financial restrictions, right? So here's one where they say you have to have insurance, you have to pay your taxes, and we're going to collect that from you every month, and we're going to pay it for you on your behalf. So the principal and interest is the part you're paying back of the debt. The taxes and the insurance is the part that can be called escrows, and the part that you sometimes pay upfront. All right. So when we're thinking about, okay, so I know what a mortgage is and I know what the 4 payments are, how do I get one? How do I know that if I go talk to my lender, they're gonna give me a mortgage loan? They're gonna lend me the money to buy the house or not? So we call this the 4 C's of lending. When you sit down and meet with a lender, they're gonna ask you, evaluate your 4 C's. And here they are: capital, capacity, credit history, and collateral. So capital, what's capital? It's just money. Do you have the down payment that we require? Can you pay the closing cost, which loan fees are part of it, right? You've heard that saying, there's no such thing as a free lunch, right? And so even a lender who says, oh, there's no fees, they might make it up with interest in the back end, but there's usually some kind of fees included in getting a loan. They do need to be paid for their service, the closing costs, the escrows, the reserve. So all these things and moving expenses, all these things that I mentioned a little earlier, that's the capital. So do you have enough capital? Do you have cash, or do you have money to cover the upfront and ongoing cost of the home? So they're going to evaluate how much money do you have. That's 1C. And so it's a good thing to keep in mind. Again, I mentioned go to our money management class to learn about saving strategies, and consider when you're saving, you have a goal, but also consider all the extra cost of buying a home. And we recommend that you budget 1% of the home purchase for upkeep. So I talked about that, maintenance and repairs that are ongoing. So 1%, if it's a $300,000 home, 1% of that would be $3,000. That would be a good idea to keep in reserve once you're a homeowner to manage those things that can come up. And then there's also the cost that I talked about earlier of filling your home. So having the money ready is great, but having that cushion is really going to protect you from default. The next C is capacity. So what's capacity? Another way of asking that is, how much can you afford? And the way that they determine how much you can afford is they look at your current income, which can be a stinker because sometimes people say, oh, I made more before at another job and now I make less, and they're not counting it. Or sometimes it's the opposite. I make a lot more now than before, so I don't qualify for a down payment assistance because I'm over income. Things like that can happen, but your current income is going to be really crucial. If you don't have any steady income, it can be pretty difficult to get a loan, right? Because they want to look at, how are you going to pay me back? So that is going to be the biggest piece of how much income do you make? And they always go off of gross income. So we might think of our pay as how much they deposit in my bank. They're going to look at that top number on your paycheck before they take out taxes and retirement and health insurance, etc. Before anything is deducted, they're going to look at that top number and count that, even though we might have less. So that can also skew things because you're going, hey, my gross pay is, you know, 4,000, and they're going off that and saying I can afford 2,000 a month, but my take home pay is only 3. I can't afford that. So it's really important to look at what they qualify you and compare it to your comfort level. So current income is important. And then income history and future earning potential is also important. So they're going to look at usually 3 years of tax history, and they want to go, have they been earning consistently, or are they new at their job, or have they been there really long term? And all those things can really work in your favor. If you have a very long-term history, even if maybe you don't make the most money, that shows, okay, this is a person who will be able to pay us long-term because they stick with it. And I want to be clear that this is not a value judgment on your person. You know, we know things change. This is more of a kind of a cold look at how do banks evaluate us. And then future earning potential, they will actually send a note to a form to your job and ask them, is this person eligible for raises? Do you think that this person is going to continue working at this job? And they want your employer to kind of make an evaluation on whether they think that you will be there long term and whether you will be getting raises. And then the third part of capacity of knowing what you can afford is, do you have debt? So do you have amounts owed? So installment accounts are things like a car loan, a student loan, a fixed amount at a fixed interval. A revolving account is a credit card. How much credit card debt do you have? How much are you paying monthly on your credit cards? And then any other monthly payments that are on your credit report. They typically don't count things that are not on your credit report, like light bill, cell phone, groceries. Even though we know we have to pay them, they don't factor that in. So also important to look at what you feel comfortable paying monthly. So when they look at what you are making and minus what you pay in debts, they'll see what's left over and check, is that enough to pay for a house? Yes or no? And they'll go from there. And then based on the amount that they decide, that's how they tell you, well, this is how much we're willing to loan you. We recommend folks stay in that range. But if you want more house, then you can do things like maybe try to boost your income, try to lower debt, or a combination of those two, to try to change those numbers so they're not set in stone. Or if you're like, no, I need to buy now, I'm going to work with this number, then find a house in that range or put a bigger down payment to help you boost your purchasing power. I see another question. Great. What if you're self-employed? So if you're self-employed, they're going to look at the last 2 years of tax returns. And that's where it's different, right? So I just said they look at gross income, but for self-employed folks, they don't look at gross income. They look at taxable income. So your gross income minus your expenses, and whatever's left, that's the amount that they look at. And then they divide by the 2 most recent tax years. So right now, if I were to apply for a mortgage and I'm self-employed, they're going to ask me for 2019 and 2020 taxes. They're going to look at both of them. They're going to get that Schedule C and see what's that bottom line, and add them together and divide by 2 and get an average. So it can be rough because a lot of times we want to write stuff off when we are self-employed. And then how do they calculate future earning potential? That's by asking your employer of what do they expect that you're going to make in the future, and what is the probability that they will continue to employ you? Great questions. Thank you so much. All right. So when I'm looking at how much can I afford, like I said, first, the most important is, what does your budget show you? When you write down the numbers, you know what comes in and what goes out, and you know what's a comfortable payment. I encourage everyone to do their own form of a budget, whatever that is. If you do it on a cash flow basis, if you do it on writing everything down, whatever it is you do, but figure out what is your comfortable number. That's going to be a great starting point to target. Because the lender, they're going to go off your 4Cs, and they're going to use what they call debt ratio percentages. So there, I wrote a general rule: 31% of your gross income if you're a W-2 employee, and if you are self-employed, then 31% of that income after your expenses. And so that's just basically, I say, an easy way to look at it is whatever you make per month divided by 3. So if you make $3,000 a month divided by 3, and the bank is going to say 1,000 of your money can go towards that house payment. And that is just for the house payment. The 43% is, if you see, I wrote 31/43, that is your house payment plus all your other debts, your car payment, your student loan payment, your any loans, maybe you bought furniture or use those. I've seen a lot of those marketing things for like Affirm, or there's another one called, I forget the names of them, but you know, there's a lot of programs now that say pay it in 4 payments, pay it in 6 payments. So those kinds of things are debts, credit card payments, all of those minimums, whatever your, not what you send. You might send extra, or you might be a person who always pays your cards off in full. That's great. They're only going to go off what the credit report says is the minimum amount, but they're going to add all those payments up, and all those payments plus your proposed house payment can't be more than 43% of all the debt. So 31, so let's say a third, and we're not going to spend a lot of time in the math because it can get us into the weeds, but just imagine a third of your gross income going to house payment, and then 43% going towards house plus all other debt. But as you can see here, I wrote, it depends on your 4Cs. So I've seen folks who credit scores are really high, close to 800, which is about the highest is like 850. So you're way up there. And they might say, you know what, this person manages their credit so well, we're gonna give them a little more wiggle room, and we'll let them spend up to 50% of their income on housing. Or they have no debt, so we're going to let them spend the whole 43% on the housing since they don't have any debt. Or they've been at their job for so long, 20 years, 30 years, long time. We're not worried about them not having the income, so we're going to be flexible. So this depends on the 4Cs, which is why I tell folks, what's your number? What are you comfortable with? Because if a lender says, yeah, you can pay $5,000 a month, okay, they qualified me for that, pre-qualified me for that, but do I want to pay that number for 15 or 30 years, depending on what I choose? How is that going to impact my lifestyle or my future family planning, right? Maybe it's just me right now and it's fine, but I know I want to have children and that's going to cost money, or daycare's coming, or things in the future, right, that we don't know. So just to get an idea, you can imagine about a third of your income going to that payment, but I'll keep stressing this. What are you comfortable with? All right. So I'm continuing with the 4Cs. So the first one was capital. The second one was capacity. The third one is credit history. And I think if you took our either a debt management class that's either already passed or there's one coming in the future, they'll go into depth about tips for improving credit. But with a lender, on top of really caring about that score, They really care about that score. We recommend aiming for 760 or higher, but I don't want folks to get disheartened. If you're not there, A, you can work on it and get it bumped up. B, there are some government loans that are more flexible with the credit limits, which I'm going to talk about a little later in the presentation. So what does the lender want? And in addition to that score, they want to know, are your bills paid on time? They do not like late payments. If you had a late payment, you have to usually explain it, what happened here, and write a letter and tell them why you paid late. They typically want 24 months of on-time payments. It's kind of interesting that you might even have a whole bunch of debt and they'll care more about, well, whether you paid it on time rather than having a whole bunch. So I might have no debt, but I paid my bills late in the last 24 months. And my colleague might have a bunch of debt, but always pays on time, and they'd be the better candidate for the bank. So they want 24 months of on-time history. Now, let's say 24 months ago, it was the pandemic, it was scary, maybe you paid late. You can explain that. And they can make exceptions, but where they usually do not make exceptions is in the last 12 months. So if any of you want to buy a home anytime soon, make paying bills on time a priority. One thing you can do is set them to auto pay. So they're all just the minimum. As long as the minimum is paid, you'll always be on time. And then you on your own, when you have time and have your budget set up, you can send that extra that you like to send. But we do not want to see a late payment in the last 12 months. It's pretty much a deal breaker. Credit history, current liability, right? So how much debt do you have? If you have a lot of debt, your score can drop. If you have less debt, your score can go up, typically, right? All of these are typical, but there's always exceptions to every rule. What's your past history, right? How did you pay things before in the last 2 years? And then if you have no credit history, that's not necessarily a deal breaker. Like you've probably heard people say this before, a low score can have a bigger impact than no score at all, but you still have options when you have no score. Yeah, and I will say aim for 760 when you're going to get your first mortgage for credit score. But like I said, there are government programs that can take less, a lower credit score. And I'm going to talk about that in a bit. So if you have no credit history, you can work with a credit counselor or a coach on building credit, take the credit class. But they also do accept something called non-traditional credit. So things that are not reported to your credit report or credit score, like rent payments, gas, electric, and utility, childcare or child support, or any other large recurring expense. So like a cell phone, something like an insurance bill, something that you pay monthly and always pay on time. You can get some of these things added to your credit. There's a service that does rent. I haven't tried them out, so I don't like to recommend things that I have not tried, but you can look up people that will report your rent, and usually they charge you a little fee. You pay them, they pay the rent for you, and then they report you every month as paying on time. But you don't have to do that. You can just be sure that you pay all these things on time, and then you can get letters from these creditors. It's usually a form that the bank or lender will ask you to fill out, or the mortgage broker that someone mentioned, ask them to fill it out, and they'll say, yes, Teresa always pays her rent on time, and she's lived here for 5 years, and she pays X per month, right? And if they can give me these things, and I can get them from the utility companies or the childcare, I can pay to have that added to my credit score. And so those are called non-traditional credits. Now, it's not going to change your credit score, but it will show up on your credit report as an on-time payment. So this is a way to build some credit if you don't have any. All right. And the last C is the collateral, the house. They want to see that the house is worth what you're paying for it. So if you offered 300,000 and the house comes out and all the houses in the neighborhood are only selling for 250, So yours is also only selling for 250 because they use what they call comparable sales. They look around the neighborhood and go, what are houses selling for in this area? They might say, you know what, your house didn't pass the appraisal if it's not meeting our collateral needs. So the house needs to be appraised by a certified appraiser who goes out and looks at the house, gives an estimate of their opinion of the value, and it has to at least be equal to the sales price. They don't want to loan 300K on a house that's worth 250 because if you don't pay it and they have to auction it off, they're going to take a loss. So in that situation, you can pay more out of pocket. So they're say, we're only going to let it go up to 250 and the other 50K you're on the hook for, or you might have to find another house. So it's really important that the house meets the appraisal. It's also really important that it meets the inspection. So they're very much going to be looking at basic safety and livability, right? It has to have finished flooring. It has to have all the windows. Things like that. So they'll look at those reports and decide whether the home meets their minimum needs. And so some of this is out of our control, right? We pick the house and we think it looks great, and then we get an inspection back and we see, oh, something needs to be fixed, or the appraiser says it's not worth that much. And so it doesn't mean it's all over. You can try to negotiate with the seller to make repairs, or to even reduce the price a bit if it's way above asking. It depends on your market. I know in San Francisco, that's where I am, people pay over all the time. But I'm originally from Texas, and that it was not a very common thing when I was growing up. And my parents are still in real estate down there, and it's not too common in the area they live in, but I think it really depends on your market. All right. Before I move on to steps in the loan process, are there any other questions about the 4 C's?
Teresa, I wanted to make sure that we answered the question, how far back do they look into credit history? Is it just active ones we have opened?
Oh, sorry, I missed that. They're gonna get a credit report and they're gonna see everything. And so yes, if I've had an account that's open for 20 years, they're gonna look at all the history. But they're most focused on the most recent 24 months. Are the payments on time? And then focused on how much do you owe? Are your payments affordable? And so that you can continue to pay them and pay your home. So I would focus on keeping the last 24 months clear. But again, if something happened, then at least focus on the 12 months. And if something happened last month, then okay, we're starting today and setting our goal of a clear 12 months and then a clear 24 months from then on. Does that answer the question? Or if there's anything else, please put it in the chat. I'm happy to clarify. Okay. So I talked about what they're looking for. When you do start the process, so those 4 C's are things that you can start working on yourself now to say, how are my 4 C's looking? Because I know they're going to evaluate them. It's also fine to just meet with a lender and have them tell you, but I recommend looking a bit yourself. I also always recommend meeting with a housing counselor. Usually those services are free, and they're trained and they have a HUD certification from the federal government so that they know all these 4 C's and they can sit with you and evaluate. And that was part of my job for many, many years. And it's just, person comes in, I look at pay stubs, tax returns, bank statements, credit report, and I tell them, yeah, you're ready to go, or you need to work on this. And we come up with an action plan and to take those steps. So I highly recommend that. But let's say that you're gonna go forward and say, okay, I'm ready to buy. This is like a timeline. So first is doing research, right? So someone asked, should I use a mortgage broker? Should I use my bank? Should I, call my friend who's a real estate agent, right? So I think checking all of that, doing maybe some searches online, talking to family and friends who have purchased, who did you use, what worked, looking online to see what are rates today, right? So you can know what to expect when you do talk to a lender. And I think there are pros and cons to anyone. Sometimes if you work with a bank and you have a lot of money saved and you've been with them a long time, they might offer you a discount, like a free appraisal or a lower rate. Some people like to go with mortgage brokers because mortgage brokers can have different options, right? If I go to Chase Bank, then I am getting a loan from Chase Bank. But if I'm going to a broker, they might actually shop me around and look with different lenders and try to see who can give them the best deal. So that could be an option. So it's really going to be up to your comfort level. And I encourage everyone to just shop around, try different folks, definitely see who's been recommended to you to move forward in that process. Once you decide who you're going to use, and you might apply with 2 or 3 people so you can compare, we recommend at least talking to 3 different people so you can see what they say and what they can quote you. But once you decide who you want to work with, then you will move into the pre-approval process, right? So that's where they're going to say, and you might get pre-approvals from all 3 to say, what are you going to give me? And they might all be the same. We're all going to lend you $300,000. Or some might say, well, I'll only loan you 240, 250, 260. You can compare. What are the rates that they're offering you? What are their closing costs? How much down payment do they ask you for? So you're looking at all of that in your pre-approval. And compare those 3. And then once you know who you want to pick, who you feel is the best offer, you would move into the loan application. So it sounds backwards, like what? I get pre-approved, then I apply. It's kind of funny, but yes, a pre-approval, sometimes it's done by just your word. You tell them I have a 780 credit score and I make $3,000 a month and I have 10,000 saved for a down payment. And they say, okay, we think we can give you this. Sometimes they'll say, show me everything, bring me all your documents, and I'll give you a quote. So that's why it's called pre-approval. But once you choose who is actually going to give you the loan, that's when you fill out the loan application. And that form is called a 1003. It's just a loan application. And you, just like any other application you might have done in your life, it doesn't necessarily have to be a loan, but it has all that identifying information, name, address, phone number. You do put your social security. They'll ask you where you work. So it's kind of like just, you're giving them all your personal info so they can make it a formal loan application. Once you sign a formal loan application, they have 3 days to give you the loan estimate. And that's where they're going to say, okay, this is real. Before I gave you a quote, here are the final, almost final numbers. They're supposed to be pretty close to the final thing. And you sign the loan estimate and you say, okay, I agree to all of these costs and expense and this payment and this down payment, etc. You sign everything. Once you sign everything, then they move into underwriting. So they're gonna ask you for all that documents, taxes, tax returns, pay stubs, bank statements, the letter from your job that you've been there, alternative credit if you need it, etc. And they go through double and triple checking everything. And assuming everything goes well, they'll move into approving you. Once you're approved, they have to give you those final last loan disclosures. And then they move into closing. And during this underwriting process, that's also when you do inspections and appraisals and surveys where they measure the property. So a bunch of things that are also looking at the home in addition to looking at you. And then assuming everything passes their requirements, you get your final approval. And then you move into closing. For loan closing, you typically need to have your ID and you need to meet with a notary, and you'll sign that promissory note that I talked about at the top and the deed of trust and any final disclosures that they need you to sign. It's usually a big stack of papers. If you're married, depending on what state you're in California, it's a community property state. So if you're married, you have to buy it together. If you are single, then you can buy, or, just not married, maybe you live with someone, but you're not married, or you just want to buy with a relative, you have options of how to buy. But if you are married, legally married, both spouses need to sign the documents. So I'm seeing some questions coming in, so I'm going to take a moment to ask. let's see. Okay. Soft pull on your credit when you go in. That's a good question. A soft pull typically is when you're not getting credit extended. Banks typically is a hard pull. So a soft pull is like when you meet with your housing counselor, they're not going to give you credit. They're just looking at it for educational purposes. If you check it yourself, that's a soft pull. But typically when you go with a lender, they do need to do the hard pull where they're really seeing what's your score. And they do a tri-merge typically. They pull all three reports because of the three scores which is Equifax, Experian, and TransUnion, the lender looks at the middle score. So not the highest score and not the lowest score, but the one in the middle of the three. And that doesn't mean an order middle. It means I have a 780, I have a 760, and I have a 740 with the three bureaus. They're going to take the not the high, they throw out the high and they throw out the low and they take that middle one. Who pays for broker's fees? Typically, we're responsible for closing costs. However, sometimes sellers agree to pay for closing costs. So a broker fee could be included there if you negotiated and said, I'm going to pay you X price and you're going to pay X% of my closing cost. That doesn't happen too much in San Francisco. Like I said, it's just a really, really difficult market, but I've seen that happen in a lot of other places. And then someone said, does your credit get pulled at pre-approval stage? Sometimes it's yes. Some people say I won't give a pre-approval without pulling your credit. Sometimes people just go off your word. Most people probably will pull it. If they don't, they will definitely pull it after the loan application. Does the pre-approval affect your credit score? So yeah, when you get your credit pulled, it possibly could affect your credit score. I won't say 100% that it will. It really depends on the length of your credit history. So if you have long-term credit and someone pulls your credit and you have this great score, it probably won't impact you. If you're new at credit or you've pulled a bunch of things, getting your credit pulled a bunch, then it could. So it just depends. We typically recommend people don't pull their credit too many times. The nice thing about applying for a mortgage is if you apply at multiple places within a 30-day window, it just counts as one pull. They don't count them separately because they know, the credit bureaus know that you are shopping around. I've heard folks say you should really try to buy a home if you go through the pre-approval process or else the money is wasted. You should try to buy a home if you go through oh yeah, I mean, maybe, but there really shouldn't be any fees associated with a pre-approval. Once you get to the loan application process, yeah, they're going to ask you for that appraisal money. They're going to ask you for that survey money you're going to spend on an inspection. So yeah, it could, but I will say, there's no hard and fast rule. If at any point during this process something doesn't look right, you can change your mind. Now, it's not recommended. There are folks who want to sue because you said you would buy it and I took it off the market, etc. So you do really want to be really, really sure when you're signing a purchase contract. But if the loan doesn't look right for you, yeah, you might lose a little bit of money, but how much money is it going to be long term if you're stuck in either a home that doesn't work or a loan that doesn't work? So I'm going to say this is going to be a very personal choice. And I would say consult with your housing counselor, hopefully, whoever else is helping you buy, your coach, whoever can help you figure that out. But in general at Sage, we don't try to do like a hard and fast rule. We try to say it depends. So it's really going to be on what that situation is looking like for you. But to your point, you will be spending money throughout this process. So you could, yes, lose money if you change your mind or back out. Do lenders prefer folks who are married? They are not supposed to. There should not be any benefits for married. Does it make sense to get a loan before you've chosen a home? Is that even possible? Yes, we typically tell people get pre-approved first, because then you know what your price range is and what your payment is, and you can adjust to that. If you start just looking at houses, you might fall in love with one that's out of your range, or you might be getting disappointed because I don't like any of these, and not realize that you actually maybe could spend a little more than what you've seen. And a lot of times real estate agents want you to be pre-approved before they spend their days doing searches and taking you around to visit homes. So I think it is a great idea to get pre-approved before. But again, whatever feels best for you. If you say, I need to go look a little to get more motivation or to figure out what price range I need to be in, that might make sense for you. Let's see. Yeah, someone said pre-approval doesn't cost much. Yeah, typically it doesn't cost anything. They're really not supposed to charge you anything until you sign that loan application and become their client. Okay, how are we doing? All right, okay, so I talked about this already, shopping for a loan. I just went over all of this. Sorry, I do all of this in that timeline. So there are some types of mortgages. So conventional, I talked about that. What I just talked about was pretty much the conventional and the government loans, that process. For non-conventional loans, it might be different. Those might be called hard money. And so folks who really are outside of the norm, maybe you can't really show your income, or it's international income, or it's you just don't have the credit score that you need for the government loans even. And so you need a hard money lender. I don't recommend these. They can be risky. They'll be like maybe short term. We'll lend you the money for 6 months while you fix your credit and figure it out. I think it's best to do all that work up front and just go into the right loan for you rather than taking on these risky loans. So I'm going to say conventional or government loan, but I don't want to shut anyone down who might really need access to that non-conventional, just not my area of expertise. So conventional loans is typical. You put what I talked about, you put a down payment, they tell you how much you're going to pay, you pay your closing costs. But for government loans, there's FHA and VA, so the Federal Housing and the Veterans Administration. Those can give you, FHA, you can get go down to a 580 credit score, and they'll still give you a pretty good rate. And VA is no down payment. So those can be options for folks who maybe don't have a 5 or a 10% down. When you're looking at your loan, we recommend fixed rates, but you can also get adjustable if it makes sense for you. If you get a conventional loan or a government loan, it's a fixed rate. That means the principal and interest portion is going to stay the same for the life of the loan. But the property taxes and insurance can change because those are subject to the market, right? If your property goes up a lot, then it's going to be assessed at a little bit higher. Adjustable rates usually start low and then adjust on a regular schedule. Maybe every 6 months or a year, they kind of go up a little bit at a time. The only reason I don't recommend those is because it can surprise you if the market really changes and the rate really changes and your payment really changes. But for some folks, they need an adjustable to start with a lower payment and plan to maybe refinance while it goes up. The only problem is, I don't know if this was covered in my bio, but I was a foreclosure fighter for many years. And one of the things that there was a lot of factors that led to the crisis, but one of the things that really caused hardship for some of the families I worked with was their loans adjusting out of what they expected. And then because the values had gone down, they weren't able to refinance as easily as they expected. And so that was quite shocking. But if you have a plan and have a good housing counselor and loan officer, and this is what makes the most sense for you, that might be the way to go. But if you can get a fixed rate and it's low, then that locks it in for the life of the loan, and that can provide a little bit of protection for you. Okay. Someone asked about USDA loans. I don't know enough about USDA loans. I'm really sorry about that, but I can do some research and maybe circle back. And then for adjustable rates, typically they will adjust at an interval. Okay. I'm gonna move on a little bit. Okay, so when you're looking at loans, these rates are a little high. I made this a while back before they dropped so much. But just know that when people tell you, quote you an interest rate, that's basically the cost of borrowing the money. So we're gonna loan it to you at this rate. Cool, okay. But they also will calculate the APR. And so what is APR? Annual percentage rate. So that includes the interest. So the interest rate, of course, but also what we call points, which are percentages of the loan, and other fees. So it takes the whole cost of the loan and then gives you that number. So just to give an example here, we gave an A and a B interest rate at a 5.75 with an APR of 7. Interest rate B at a 5.5 with an APR of 7.75. So someone might say, look, they gave me a 5.5. This looks way better. And then a 5.75, and might even turn their nose up at their friend. I got a better rate than you. But when you look at the APR, that's a sign that they paid higher fees than loan A. So it may or may not be a better deal. So the point here is just to let you know to look at both. When you're looking, when you're getting your quotes, look at the interest rate and the APR, and not just one or not just the other. Here I talked about, so a point, right? So just because you might hear this when you talk to the lender, a point is a percentage of the loan amount. So 1 point equals 1%. You might get charged origination points. So those are fees charged by the lender to make you the loan. So they'll say, we're going to charge you a point, or we don't charge any points. Nice. It varies by lender. But they are tax deductible that first year that you buy the house. So you would want to tell your tax person, I paid a point to buy this loan, so that they can write that off for you. And then there's discount points. So those are upfront fees paid to receive a lower interest rate. So I put a little pretend interest rate chart here on the side. So maybe the rate for today is 4.25, 4.25. And if you can see next to points, it says 0. So if I give you a 4.25 rate as your lender or broker, it doesn't cost you anything. Everybody can get that rate right now, today, if we lock your loan. But say you really want a lower rate. You want a 4% or you want a 3.8 because you know that a lower rate is going to give you a lower monthly payment. Well, they might say, sure, I can do that for you, but I need to charge you. You're going to pay upfront 1 point or 2 points here for the 3.875. So you're going to pay 1% or 2%, et cetera, to buy your loan rate down. That's what that's called, a buy down, or a discount point. So for some folks, this makes a lot of sense. You get a big loan and you buy your rate down and you have a much lower payment. Long term, you're going to save money. For some folks, if maybe they're only borrowing a little bit, a point might not make that much sense. So I encourage folks to do their own calculation, ask your housing counselor or your loan officer, can you do the math for me and see when I break even, do I break even in 2 or 3 years where I get the money back that I paid up front by paying a lower monthly payment, or does it take me much longer? Let's see. Okay, so mortgage insurance. So I talked earlier when I said with the PITI, part of it is property insurance, but part of it is mortgage insurance. So for conventional loans, if you pay less than 20% down, you typically have to pay mortgage insurance. It varies by different factors like your credit score or how much you borrowed, what the home is like. Typically, they want you to have at least a 720 credit score to get mortgage insurance. And that covers the lender in the case that you default. It's kind of like an insurance that says it's protecting us if they default. So if you give 20% down or more, you don't have to pay this, but if you give less, you might. If you take a government loan, there I put the FHA number, you pay 1.75% of the loan upfront. So you multiply the loan amount times 1.75 upfront, and just that's the fee for that sort of insurance policy in a way, if you look at it that way. And then monthly, you can pay from 0.45 up to 1.05. They'll divide that by 12 monthly. So it's not like all that number every month, but whatever that comes out to. So say 1% of 200,000 is 2,000 divided by 12, you'll pay that monthly. And this is also like paying what they call the premium, the MIP, mortgage insurance. The P part means mortgage insurance premium. So the good thing is this comes off with FHA after 5 years and at least 20% down. They will remove this with conventional once you get to that 20% down. So I bought it with maybe 5% down, but I've been paying every month. And now after X amount of years, I owe less than, I'm down to having at least 20% equity, or they can remove it. But it is a cost that's associated with purchasing. Okay. I did see a question. I'm gonna just go through a little bit more here, and then I'll take some more questions. So I said earlier I would talk about closing costs. So just some examples of closing costs: origination fees, those points, or lender fees, a transfer tax that does happen in San Francisco. I'm not sure if that's in every county, but sometimes you pay a fee to transfer the property from one person to the other. Title fees. So I have to get the title of the property, right? Like on a car, we get a title. On a home, we get a title that shows us it's free and clear. Nobody else owns it. I'm listed as the owner. I have to pay for those title companies to do the research and find out who's the true owner, make sure there's nothing owed on the back, and that you're now the new owner. Recording fees, everything has to be recorded at the courthouse to be in effect. There's fees for that. And then what I talked about also earlier, the escrows, upfront property taxes, right? It's January and they're due in April. I need to pay a little bit upfront so that they know they have it. Upfront insurance, that first year of insurance needs to be paid. So those are closing costs. We recommend having 3 years of documents to show when you meet with your lender. So this is just a list of things that you can get together to make it easier for when you meet with your housing counselor or your loan officer. The most recent 3 years tax returns, the most recent 3 years W-2s or 1099s, the most recent 3 pay stubs if you are W-2, or a year-to-date profit and loss if you're self-employed. So right now, let's say you went to meet with a lender, you haven't filed 2021 taxes yet because it's still early and most folks don't get everything until the end of January. So we have a few more days. Okay, well, I'll just do a profit and loss to show what I made in 2021. And then I'll show my taxes for the previous 3 years that I do have so that they can see. And a profit and loss is pretty much going to match what you put on the Schedule C. How much did you make? How much did you spend? How much was left over? And that's your profit and or loss. Your most recent 3 months of bank statements from all accounts. Documented rental history. You may not have that right up front, but be able to get it, to talk to your property manager or landlord to get your rental history to show that you're paying on time. First-time homebuyer certificate, I add this because if you can meet with a counselor and get that certificate, that can be really, I think that's just a really important step that can help you. If you get a government loan, they often require that certificate. So they require that you do those meetings in order to purchase. Sometimes lenders will give you a tiny little rate discount if you have your certificate. And then your driver's license so that you can prove your identity, and you especially needed to sign those documents. Okay, next. Okay, I talked about the underwriting process already. I get ahead of myself sometimes. Legal reasons for rejection. So someone asked earlier about is it better if you're married, right? So they're not supposed to be able to discriminate based on any of the protected classes. So they can't discriminate for things like, some people worry about being too old. Like, am I too old to buy a house because maybe I won't live 30 years? They're not supposed to be able to discriminate on those things, but these are the legal reasons for rejection. If your debt is considered too high, if you don't have enough capital money for down payment or closing costs, if the home doesn't meet the appraisal, if your credit score doesn't meet their minimum requirement, or fraud, right? If I said, I've told my friend, just when they call you, tell them I work there, kind of thing, and they find out, then yeah, they could legally reject you. Any questions right now? Or Nina, if you see any. Okay.
Yes. There was there's been some conversation in the chat about how frequently interest rates change.
Okay.
And there was also a question, FRM versus ARM can be for different years. I'm not quite sure.
FRM, is it fixed rate mortgage versus adjustable rate mortgage? Yes. Okay. Yeah, they can be different. It can be like a one, what do they call it? Like 5, which would mean like changes once a year for 5 years. Yeah, it can be different. Let's see, how frequently interest rates change. Yeah, multiple times a day. That's exactly right. Thank you, Allie. That's exactly right. They can change multiple times a day and every day. And yeah, so when you're getting ready to lock your loan, you do want to keep an eye on that. All right.
And then just going back a little bit further, after the pre-approval, can you get a loan without a specific property on the table?
It won't become that's a great question. Thank you. It will not become a formal loan application until you attach a property address.
Okay.
All right. So when you're shopping for a home, if you decide to use a real estate agent, their job is to find the properties that meet your needs. So they have a fiduciary responsibility to protect you throughout the sale, tell you about the neighborhood, research recently sold homes to tell you, here's what they're selling for. So here's about what your offer should be. They write, present, and negotiate your offer and refer you to other professionals to meet any escrow requirements. So they might help you get connected with an inspector or with an insurance agent. I still encourage folks to do their own research, but a real estate agent can be a really great effort. A really great effort. Sorry, they'll put in effort, but it'll be a great asset. That's the word I was looking for. Pardon me. If you do not feel like they're looking out for you, you're free to switch around because they are supposed to be looking out for your best interest. So here again, asking for recommendations from friends or other family or people you trust. Interview 2 to 3 agents, confirm that they are licensed and a member of the Board of Realtors. So you can go to dre.ca.gov, Department of Real Estate, California. This is California, but you can also check in your own state if you're outside of California. You do want to make sure they're licensed. And we put here, beware of dual agency. So it's totally legal, but sometimes a realtor, a real estate agent can represent both the buyer and the seller. So when you see a sign outside a house that says call Coldwell Bankers or call Prudential or call, right? Those people have been hired by that seller to market the home and sell it. So when you call that person, they're already working for the seller. And so if they then decide to represent you, that's called dual agency. It's perfectly legal. It just has to be disclosed. And you just want to make sure that you feel comfortable with that because their job is to get the highest and best price for their seller. And they now are representing you and need to also get you the best price. Since you both have competing interest, I think it can be hard and not impossible, but it can be difficult to hold that neutrality and then that confidentiality, right? Between they know the highest price, they know the lowest price their seller is willing to get, and they know the highest price you're willing to get. And they can't really use that information, but them knowing it just kind of is a gray zone. So you can get an agent that way. And I'm not going to say, you can't do that. But I think the best way to get an agent is to interview yourself and choose your agent rather than, oh, they became my agent because I called the number on the sign that I was driving by and I liked that house, right? Which is also a fine way to do it. It can work out. But I really like to encourage folks to just be really intentional when they're going about finding their right person. Let's see. Oh, so agents get paid typically by the seller. The seller usually hires them to market their property, charges them and then the seller pays them a percentage of the sales price. And then that money that they charge, if a buyer's agent brings them a buyer, they usually split it with that buyer's agent. So that's typically how it's done. But sometimes a buyer will just hire an agent and pay them to help them find the home. But typically it's paid by the seller, and it's not paid up front. It's usually paid at closing. The real estate agent's commission is taken from the seller's proceeds. These are all really good questions. Thank you. So they're supposed to make the offer. So you hear it called we call it an offer, but it looks just like a contract. It's like a purchase contract. It's just not called a contract until both sides have agreed. So when you first write it up, it's called an offer. And it has the address of the property, the price that you want to offer, the amount of money that you're going to give up front, which is called earnest money or good faith money. It might not be the whole down payment. Maybe you're told you need to give 10% down. You're just going to give 3%, write a check to show that you're acting in good faith, right? Earnest, you're serious, you want this home. And that money, that check that you write or money order is usually held by the escrow company, a neutral third party. So it doesn't go to seller and you don't keep it. It's held by that third party until the end of the transaction, and then it's applied as a credit towards that purchase. The offer will also say, how are you going to pay, right? You're getting a loan, you're paying cash, you're using down payment assistance. It'll say when you're going to close. So when am I going to be done and give you all this money, seller? Because they want to know. And just the way they want to know when they're going to get paid, you because these did not go through the way I needed them to for this to work. And then personal property, the stove, the dishwasher, the refrigerator, right? A seller may or may not include personal property. Sometimes you walk in, you see this beautiful home, and then when you think, oh, I'm getting all these things with it, and no, actually, we were planning to take our washer and dryer with us. That's okay. I just need to know so that I can plan and know what I'm offering and for what. So if you are really your heart is really set on getting that washer and dryer, make sure that it's in the contract so you can protect yourself and have it in writing. Once, so you make an offer and they have a choice to either accept or counter offer. If they accept it, they sign it, it becomes a contract. If they counter, then they send it back to you and say, no, change this, change that. And then you get to mull it over. And if you accept it, then it becomes a contract, or you can also counter back, or you can say, no, thanks, this doesn't work, right? So you'll negotiate. Once everyone is in agreement on what's in that offer, it becomes a contract. And then the escrow period starts. And this is usually referred to as being in escrow. And that's during that process, that's when you need to get your inspections done, your appraisals done, you're looking for your insurance agent, right? All for the homeowner's insurance. You'll be doing all these things. And this is just a movie that was recommended called Closing Escrow. That is just a funny movie. And then what does the timeline look like to purchase? Well, we recommend you tell your lender right away when your offer gets accepted, because they need the max amount of time to get that loan done. You don't want to wait a couple of weeks and then go, oh, guess what? We found a house, because now they're behind on that closing date. So as soon as you know, tell your lender. Typically, you have 17 days to get your appraisal done, another 10 to 17 days in that same window to get your inspection done. And then during this time, you'll be wanting to get that loan locked. So that's why I talked about watching those rates, checking with your lender, checking with your housing counselor, figuring out when's the best time to lock the rate. Maybe today the rate looks really good, so let's go ahead and set it in place, because it's floating, it's changing all the time until you say, okay, that's the rate I want, and they lock it. Remove contingency. So any contingencies you put on there, you said, I need to get the financing done, I need to get the appraisal done, I need to get the inspection. Start removing all of those, saying, okay, they're check, I'm still moving forward, or no, I'm not. If you're not doing what you said you would do by the dates you said, they might send you a 2-day notice to perform. They're going to say, hey, you haven't done X, you haven't removed this contingency, have 2 days to get this done. They'll let you know. If the timeline's not going quite the way you need, you might need to get it extended. Or if something doesn't look right to you, you might need to cancel. You need to do this in writing and it needs to be communicated. Typically, your agent will be handling all of this, but there will be a lot of communicating in this area. Then you get to close. So that's where you sign with a notary, like I talked about, and then they get everything recorded. Now, once it's all done, where they told you it's recorded, it's funded, which is the money that you are borrowing actually gets wired to that seller. Then you can set up all the utilities in your name and then give proper notice to vacate. I know folks get excited and maybe they say, oh, we're closing on Friday and I don't want to, it's already the 25th. I don't want to stay here one more month. I'm going to tell my landlord I'm going to be out. And then something gets delayed or extended, or even worst case falls through. And now what, right? Your landlord already thought you were moving out. Maybe they already rented it to someone else. So we really recommend that you wait until you have those keys in your hand so that you don't end up with nowhere to live, unless you have a really good backup plan, like maybe family that says, yeah, you can stay here until it gets done. We don't mind, but in general, it's best to wait. All right. So I was going to talk about protecting your investment, but that comes after you purchase, and I'm going to really just focus on purchasing. So I'm just going to move into some inclusionary housing programs. So these are just options that can help you purchase. And so I'll just go through them. Section 8. So Section 8 is that program where the government assists us with housing, right? It's like a voucher, and they typically pay a portion of your rent and you pay the other. You pay what you can afford up to about 1/3 of your income. And let's say the rent is higher than that, then Section 8 comes in and helps with that remainder. So there's a Section 8 purchase program where that same rule applies. You pay what you can pay up to 1/3, and they will help you with those housing payments for a fixed period of time. So if you have Section 8, I encourage you to, which can be pretty hard to get on those lists, but if you have it already, that's a great option to talk to your Section 8 housing counselor and ask them about the Section 8 purchase program and see if you're eligible and if they have funding for it. Another way is with down payment assistance. In San Francisco, they will loan you up to $375,000 with no interest and no payments to purchase your first home. And that's coming from the city government. In my hometown where I'm originally from, they'll loan you up to 20% down. They're much less expensive homes, so they can afford that. So they'll loan you up to 20% down with no payments and no interest to put down on your house. So I recommend that you check with local government, go to a city of wherever you live and see if they have any housing programs. Check with any nonprofits, ask your lenders because they sometimes have funding, and check with your housing counselor. I really recommend a housing counselor because they usually know all the resources available in your area. If you're a teacher, there's a teacher next door program that can give you, loan you up to $20,000, and it is a forgivable loan. So as long as you stay with the school district in your area, assuming they're offering it for 10 years, they will forgive that down payment money. The police in the community, that if you're a police officer and your local government or local district has funding, they can also loan you a down payment, and that is forgivable usually after 5 years. So they loan it to you as long as you stay in the home, they forgive that down payment money. The mortgage credit certificate, this is also depends on your locality, but you can get assistance for on your taxes. So you apply for it, and then they're going to give you a certain percentage of like a rebate back on your taxes every year. The WISH program, that is an IDA, an individual development account. So you save, and for every dollar you save with Wish, they give you 3 up to $5,000. So you save 5, and if they give you $3 for every dollar, you save 5,000, that's $15,000. So that would give you a total of $20,000 down to purchase your home. And then Habitat for Humanity. That one is a program where you can buy with 0 down payment, but it's only on homes that they have deemed Habitat for Humanity. So they usually build them, and usually you have to participate by helping to build the homes. So those are some options for inclusionary housing programs. Let's see. I'm going to look at the questions again. Can real estate agents provide recs for appraisers or inspectors? Not for appraisers, that is chosen by the lender. But for inspectors, yes, they can. I still recommend everyone research themselves. For March 1, I don't know that. I might do a repeat, or I can definitely go deeper into some of these other topics. I'm going to double check with what the group would like and what my supervisor is recommending. If you're a first-time home buyer, but your spouse is not, typically when you're married, they want both parties to be a first-time home buyer, but I recommend that you check, because some programs are pretty strict about that and others might be less so. So here is the website to talk to a housing counselor. You can also just do a search engine, HUD housing counselor, and it gives you a link to put in your, either click your state or put in your zip code and find a counselor in your area, especially if you want to find out about inclusionary housing programs. And before you go, I just want everyone to put in the chat, what is your next step? We're all in a different spot. What is something that you can do this week? Or what is something that you can do next, or first? What's the first thing that maybe you just need to take a peek at your credit score? Maybe you just need to work on paying down this one credit card, right? What do you think that you can do to get you started on this path? And that's it. So Nina would like for everyone to please complete the survey. Oh, I like this. Starting my NACA profile, updating my budget, right? To see where I'm at, looking at my credit score, gathering my information for pre-approval, saving for down payment, talking to a housing counselor, revise my budget. These are all excellent ideas. Thank you so much. I'll stay on a little longer if that's okay, Nina, just to take any questions. But otherwise, we're done for today. Thank you so much.
Yes, thank you, Teresa. That was really amazing. You're getting a lot of positive feedback in the chat. So much appreciation and gratitude to you. As was mentioned, Teresa will come back for another workshop in March 1st, but our next workshop actually that's coming up is on February 8th. And that's going to be on credit and debt. So I just put the link in the chat so that y'all can register, and then we'll continue to share more registration event information as dates approach. But I will just plug the survey again. We appreciate your feedback, but yeah, so thank you so much, Teresa. And we'll stay on a little bit to see if there's any more questions. Can you please share the website for Wish? I see just came in.
Sure, let me look it up.
And then while Teresa's doing that, we will send a follow-up email with the recording and the PowerPoint, I believe. Teresa's contact information and contact information at Sage Financial Solutions, who we partner with to put on these financial education workshops.
I'm not finding a general site for Wish because it's through the Federal Home Loan Bank who offers the program, but then your individual banks need to apply for the fund. So not every fund will have them. Not every bank will have wish funds, but I know in San Francisco, Union Bank has them, and so does Boston Private. I know those two. So I'm gonna have to do a bit more research, but if you could put in the chat what area you're in, I might be able to find where it's offered in your area. And that's a question for Jacqueline. Pico Rivera. Okay, I'm gonna look it up. Oh, I'm so sorry. I'm not having luck, but how about give me some time and I'll email Nina. Nina, you would have Jacqueline's contact information?
I
correct?
do actually have
All
Jacqueline.
right, great. Thank you.
Yes. All right.
Thank you, everyone.
All right. Thank you again, Teresa. So appreciate you sharing your knowledge and your time with us. I'm looking forward to March.
All right, I'll
Good
see
night,
you.
everyone.